Good morning. We'll go ahead and get started. My name is Doris Rentschler. I'm the Executive Director of the Mendocino County Employees Retirement Association, hereafter called MCERA. And there I am. We were having camera difficulties. So we'll go ahead and get started, even though we're expecting another 20 people or so to join our webinar. We have a very full agenda, and I want to run through our presentation before we turn it over to our other representatives to discuss. So today we'll go through an overview of MCERA, the eligibility for tiers, reciprocity, examples of a retirement benefit, a little bit of information about our self-serve portal and how to plan for your retirement. So MCERA is a defined benefit plan. It provides retirement, disability, and death benefits to our members and their beneficiaries. As a defined benefit plan, your benefit is defined by a formula in the state law. It's a formula that uses a 3-year final average salary, years of credited service, and a benefit multiplier that is based on your age at retirement. MCERA differs from other retirement savings accounts that you may be familiar with, like deferred comp or a 401k or an IRA, because your benefit out of MCERA isn't directly tied to how much you contribute into it. It's based on that formula, not your account balance. So your pension will not change with changes in the stock market. Your benefit from us is guaranteed for life. So while you can spend down all of the money in a retirement account and IRA deferred comp, you would not be able to outlive your MCERA benefit. So membership in MCERA is mandatory for all employees who are working at least 80% of full-time for the county, Superior Court, or the Russian River Cemetery District in a pension eligible position. I talk a lot about PEPRA in this presentation, and PEPRA stands for the Public Employees Pension Reform Act, and that applies to our new members who were hired on or after January 1st, 2013. So while this webinar will focus on information for members who will eventually retire from MCERA, here's a little summary of what options you have if you leave employment prior to retirement. You can leave your funds on deposit with us. Your funds consist of the contributions you've paid in during your career here and the interest that's earned on it that you receive semi-annually every June and December. While your funds are on deposit with us, they will continue to earn interest. If you leave employment and go to another public employer in the state of California, many of them will establish reciprocity, and that allows you to have sort of the combined benefits. Your service with one counts towards your eligibility for benefits in the other system, and it allows you a way to link those retirement benefits. So you could establish reciprocity if going to a new public employer. Once you've separated from employment, though, even if you said you wanted to leave your funds on deposit with us, you can change your mind and refund your account balance or roll it over to another qualifying retirement plan at any point in time, as long as you don't have reciprocity or you have not already retired. So you can leave your funds on deposit with us until you qualify to receive a retirement benefit and choose to retire. To qualify for a retirement benefit, you must be vested, meaning having 5 years of credited service, and reach the minimum age to receive lifetime pension benefits. Reciprocity, as I said, links those retirement benefits between different public employers. To qualify for reciprocity, the break in service and employment between those two public employers must be less than 180 days. You cannot have any overlapping service, so you have to fully leave one employer before you start with that other employer. And reciprocity is not automatic. You do need to file an application to start that process. So if you do leave employment and are interested in establishing reciprocity, reach out to your previous system. Establishing reciprocity may change your vesting schedule, your eligibility, or even your benefit formula. So it's certainly worth looking into if reciprocity may apply to you. We have 3 membership groups that participate in a PEPRA tier. We have our general members, we have our safety comprised of the sheriff's department, and we have safety comprised of the probation department, as far as those members engaged in active law enforcement activities. So for our general membership, you do have to have 5 years of service to be vested, and you cannot retire until you obtain a minimum age of age 52. With our safety and probation memberships, again, they need the 5 years of service, but they're eligible to receive benefits as early as age 50. The benefit formulas and the code references are provided below that. The benefit formula, the multiplier changes based on your age at retirement, and we'll go through an example of that here in just a little bit. The benefit formula uses your final average salary over the highest 3 consecutive years during your employment, or out of the last 10 years of employment, I apologize, your benefit multiplier, and your years of service. So here's an example with a $3,000 final average salary. A general member retiring at age 62 would have a 2% benefit multiplier. In our example, there's 10 years of service, and the benefit amount is $600 per month. When you actually retire, you'll get to choose from a variety of different options the plan offers. The unmodified option is the formula I just illustrated on the previous slide. It pays the highest benefit to the member and has a 60% continuance to a qualifying spouse, domestic partner, or minor child. That benefit is only to a qualifying spouse. If you have a beneficiary who is not a spouse, they would not receive a continuance under the unmodified option. When I say a continuance, it means a continuing benefit for the lifetime of your beneficiary. Option 1 does not provide an ongoing continuing benefit to a beneficiary, but it has a higher potential lump sum payout if you have not received in annuity payments out of the system the amount of what your contributions and interest to the system totaled. Options 2, 3, and 4 all involve the member taking a reduction in the monthly benefit that is paid to them in order to provide a continuing benefit for the lifetime of their beneficiary. Option 2 has a benefit to the beneficiary that is equal to 100% of the amount we're paying the member. Option 3, the continuance amount is only 50%. And option 4 is a customized benefit where you can select the continuing percentage you want to provide to your beneficiary. And option 4 also allows you to customize an option that would pay a lifetime benefit to more than one beneficiary. We often see this used in instances where there's a divorce order that requires a life benefit to a former spouse, and the member also wants to provide a benefit to a current spouse. Here's an illustration. This one's using the safety formula of that benefit calculation. I picked a final average salary of $7,500 a month. The benefit multiplier for a safety member at age 53 and a half is 2.35%. I did mention earlier that your benefit multiplier is dependent upon age. Your multiplier goes up every quarter a year. So it was different at age 53, at 53 and a quarter, 53 and a half, etc., up to the maximum number of years as provided in the law. In this illustration, the member had 17.39243 years of service. I wanted just to illustrate that, showing that we use service out to 5 decimal places. We're not rounding it down to whole years. And in this illustration, the member would receive a benefit of $3,065 per month. In the table on the right-hand side, you can see that If the member takes that unmodified option and has a qualifying beneficiary who survives them, that pension would pay a continuance of 60%, being the $1,839. You can also see what continuing benefit would be payable under the option 1, option 2, or option 3. We have a member self-serve portal called Member Direct. Member Direct allows you to access information about your account and even run your own pension estimates. It has a lot of useful information, and you can also access your annual statements in common forms like beneficiary designation forms. Many of you are already familiar with Member Direct because you registered to participate in this webinar through that website. In addition to being useful to active employees, there are a number of functions for folks who are retired. Retirees can use the site to access the direct deposit advice statement of their benefit payment, their annual tax documents. They can update their address or change their withholding online. They can also access common forms like direct deposit and beneficiary designations. So it's a very useful facility for our members to, even once they retire. So at this point, I'm going to leave the part discussing specifics about MSERA and talk more generally about planning for your retirement. So one of the most important things you can do is spend your time focusing on areas that you can control. And while it's certainly important to consider areas that you may have limited control over or even no control over, it's important that you take the time to look into what aspects you can control and how you can affect them. So your spending versus the amount you save, your asset allocation, and the types of accounts you're using for retirement savings are more in the realm of where you have total control. Charles Schwab's survey said that more than half of the people they surveyed spent more than 5 hours researching when to buy a car, and more than 39% of them said they spent more than 5 hours planning an annual vacation, but only 11% of those surveyed said they spent 5 hours evaluating investment options for their retirement. And about a third of those people said they spent less than 1 hour. And doing this is one of the most important things you can do to help ensure you have a financially secure retirement. On average, people spend 20 to 30 hours planning a vacation, according to one survey I saw, but not the time spending their retirement. Their retirement could last, 20, 30 years or longer. So it's certainly daunting, but worth the effort to put time in on planning your retirement. You cannot plan for every possible outcome, but the idea is to look at those items and control and plan for the things you can, and even have some contingency planning on what your retirement would look like for events that occur that are outside of your control, like the bigger economy and things like that. So, as I mentioned earlier, you can never outlive your MSERA benefit, but your MSERA pension will never increase. We have no cost of living adjustment for our PEPRA members, so it is even more important for our PEPRA members to take the opportunity while they're working to save funds for retirement so they can augment their benefit from MSERA and provide essentially their own cost of living adjustment over time while they're in retirement. What can you do now? Early in your career, start saving for retirement, save more. Make it automatic so you don't have to think about it. I like to participate in deferred comp because it comes directly out of my paycheck before I even see it. And since I don't get it in my hand, I don't have to worry about spending it. Whether it's an automatic contribution from your checking or savings to an IRA or a deduction out of your check directly into deferred comp, automate as much as you can of your retirement savings to make it easy and to ensure that it happens all the time, because consistency is very important. You can start small, but try to increase that every year. Start with $20, $25 a paycheck. When you get any kind of pay increase, put half of that into deferred comp and just keep increasing your contributions over your career. Even if you're relatively close to retirement, it is not too late to start saving and to have an impact on your financial security when you retire. So the building blocks of your retirement income will come from your MSERA pension, Social Security benefits, your savings and investments, and perhaps part-time employment or other income that you may earn while retired. Financial advisors recommend that you replace 70 to 80% of your pre-retirement income level. MSERA alone will likely not be enough. It's quite possible even MSERA and your Social Security benefit may not be enough. Social Security is available as early as age 62, but that is a permanently reduced benefit. So you may have to consider, oh, I'd like to stop working at age 58, but Social Security benefits aren't even payable. You have to take into consideration the timing of when those income sources will start in your retirement plan and how will you bridge that gap. We do make several methods available to you so you can obtain an estimate of your MSERA benefit. You can use the member self-serve portal, Member Direct, if you are not already registered. You do need a PIN number. You can contact our office and we will mail you your personal identification number so you can complete the Member Direct registration process. You can also contact our office and request an estimate and we'll send that out to you. If you are wanting an illustration of an option 4 benefit, since that is customized, that's not something that can be programmed into our self-serve portal, you would need to contact us for more information regarding that. If you have pensions from a previous employer or a reciprocal agency, reach out to them and get an estimate of what you might expect to receive and when you could receive it. Social Security has several different estimators on their website. So you can use the Social Security Administration SSA.gov website to obtain an estimate of your benefit or register for a myssa.gov account, which has information specific to your earnings history. Also, your IRA provider or deferred comp provider can help you with illustrations of what you may receive as far as income from those accounts once you retire. One aspect of retirement planning is estimating not only the income you're going to be receiving, but your expected expenses. You'll have housing expenses. Is that going to be renting versus owning? If you own, will your home be paid off? If you're renting, what rent increases might you expect? You know, if you own a home, even if it's paid off, there's going to be property taxes and maintenance. So be sure to estimate those expenses. I know it's hard when it could be many years away, but those are items that you would want to certainly consider. And as you get closer to retirement, you can be more detailed in your planning. Health insurance, prescription costs and copays. Medicare is not available until age 65. The county does not offer our retirees a retiree medical insurance plan. So if you did leave employment prior to age 65, what other options do you have for insurance? Do you have something available through a spouse or a previous employer that makes retiree health insurance available? Are you eligible for military VA benefits or TRICARE? Are you going to be purchasing insurance in the private market? Those are all considerations because that will certainly impact your budget. You need to estimate what taxes may do. And again, that's a little bit of an unknown, but you can sort of use the current brackets to determine how much of your income will be taxed. Food, everybody eats. So you'll need to budget something in your estimated expenses for food, for emergencies, for entertainment, hobbies, travel, all of those things. And don't forget to include those periodic expenses that pop up only once or twice a year, like your car registration, your car homeowner's insurance, gifts, birthdays and Christmas. Anticipate those things and include inflation costs in your assumptions. So when I talk about planning for retirement, there are some common pitfalls that are seen. People have a tendency to underestimate the amount of their expenses. They underestimate the cost of health care coverage. That's not just the insurance, but also what their portion of the payments may be to see a doctor and to cover for prescriptions. They underestimate housing costs, underestimate leisure spending, and that's an important one. Long-term care, are you going to have insurance? Will you be paying out of pocket for potentially assisted living or a nursing home? A more common occurrence coming up is that we see grandparents supporting their grandchildren, or are retirees helping out their adult children. So if you plan on or expect that you may need to help support your family members, you need to build that into your retirement planning. One thing that we don't talk about very often is what happens if the primary earner dies after retirement. So as I mentioned, we have options that provide a continuing benefit to your beneficiary. In this case, let's pretend the beneficiary is a qualifying spouse and that the member took that unmodified benefit, so they're getting the highest monthly payment available to them. But upon the death of our member, we will pay a continuing benefit to that surviving spouse, but it's only going to be 60% of what the member was receiving. So is that going to be enough to maintain the standard of living of your survivors if something happens to you? Because not only would they lose a portion of my pension, they could also lose Social Security income coming into the household. We both, my spouse and I, have been receiving Social Security benefits, but if I die, the amount of Social Security benefits paid to the household could drop significantly. And you really need to look at what options are you going to do to ensure the standard of living is maintained if either party dies, if there's two people or more in your household. It might be that you're choosing life insurance to fund those benefits to your spouse or beneficiary. It's important, though, if you do something like choose to use life insurance instead of choosing a pension with a higher survivor's benefit, that you ensure you can afford to pay those insurance premiums over your entire retirement. If life insurance gets too expensive and you stop paying for it and that policy terminates and then you die, again, your beneficiary doesn't have that income that you expected to provide for them. So it is important that you know you can pay those premiums over your anticipated retirement as long as they are necessary. So there's a retirement life cycle that has a tendency to be three phases: the go-go years, which are immediately after someone's retirement into the 70s, say. And the biggest risk there, and I've seen this personally, is people have a tendency to spend too much of the savings they put aside for retirement too quickly once they retire on travel and leisure, or buying a new home or vehicles or things of that nature. It seemed like they had a lot of money set aside. They wanted to enjoy it because they had spent years saving. They wanted to enjoy the fruits of their labor, but they spent down their retirement savings too quickly, and it wasn't there to help support them as they aged. And really, the reason you're saving for retirement is so that you have those resources to provide for you as you are older and can no longer work. So the slow go years start around the 70s, run potentially into the 80s, and that we typically see a reduction in activity level and increased spending on health issues. In the no-go years, health and long-term care costs increase because folks are moving into assisted living or nursing facilities, or they have just higher medical expenses in general. So even though they're not spending as much on travel and leisure, their expenses are still increasing in those later years. You will want to consider the impact of inflation. So I picked some fairly common commodities here and gave the prices back in 2001, in January of 2001, and in January of 2033. Your retirement could last 20, 30, even 40 years. Your MSERA benefit has no cost of living adjustment. So you do need to be prepared to sort of fund your own COLA in order to maintain your standard of living. You can see that a basket of goods that cost $9.63 in 2001 was more than twice as expensive, almost $24 in 2023. And that's a big jump in prices over those 20 plus years if you don't have any additional income coming in. So here I've sort of graphed the same concept. The blue line represents your MSERA pension benefit, and you can see the MSERA benefit never changes. The orange line are expenses that have been going up or would go up over your retirement. The gray line is an adjusted pension. It includes the MSERA benefit plus distributions from retirement savings in order to help maintain that purchasing power throughout the retiree's lifetime. So when this member first retired, the orange line was well below what their pension benefit was. So they thought, oh, I have more than enough money to retire. I have a surplus. There's more money in my monthly pension benefit than my monthly expenses are running. However, that changes over time. And at some point, they need to start augmenting their MSERA pension benefit to try to keep up with inflation and the cost of everything over time. This is, health costs, gasoline, insurance, things rarely go down. When they do, they often don't go down for long. Once the orange line is above the blue or the gray line, there's a deficit. There's more inexpensive than what the income they have coming in would cover. So what happens with that? If you want to, or if you are projecting a shortfall, if you're running estimates right now and your projected retirement income is greater than your estimated retirement expenses, what can you do now while you are still working? You can pay down debt. Your post-retirement income will go further if you're not saddled with having to make debt payments, whether that's cars, credit cards, or even a mortgage. Try to pay off as much debt as you can while you're still working, because you'll have more flexibility in your benefit typically while you're working than you would when you retire. You can consider working longer, so your retirement income will be higher. Your MSERA pension benefit would increase the longer you work, because hopefully your average salary would increase because of salary increases, and you would have more years of service. So your MSERA pension benefit would start out higher when you retire by virtue of working longer. And we do use that age-graded multiplier. So it also maybe benefit you by having a higher pension multiplier. Working longer could also impact your Social Security benefits and result in a higher Social Security benefit when you are eligible to receive benefits from Social Security. Working longer also gives you more time to save. It's more time for the money that you have invested to grow and compound. You could also consider a transition into retirement where it's phased in by working part-time before you retire fully and stop working. One option that isn't listed here, but certainly is a consideration, is you can revise those expenses and anticipate a reduction in your standard of living. But most folks kind of want to keep the same standard of living they have now once they retire. And when I talked about those go-go years, people have been working, it takes up quite a lot of your time, 80 hours every pay period. Once you stop working, you have a lot more free hours in your day. And people have a tendency to fill that up by going out and doing things they wanted to do and didn't have the time to do because they were working. And that's why you see an uptick in spending in those initial retirement years, as people now have the time, because they're not working, to go out and do things that they wanted to do. So this slide illustrates the benefits of working longer. In this example, working longer increased that member's final average salary from $5,000 to $5,500 a month. It added 5 years to their total years of credited service at retirement. And we also give you credit for the amount of sick leave you have on the books. So in this case, a member had a quarter of a year accrued leave time, and that's added to the amount of credited service from their employment. The benefit multiplier changed. In this case, at age 55 and a half, it was 1.35%. That's 1.35% of your average salary for every year you work. And the benefit multiplier went up to 1.85%. You can see the change in monthly benefit. In addition to having those higher benefits, they also benefit by having fewer years to wait until they're eligible to receive Social Security benefits. And during that time, they'll have reduced their reliance on the amount of retirement income that there needs to be provided by their retirement savings, deferred comps, IRAs, because instead of leaving, let's say 7 years before being eligible to receive Social Security, they only left 2 years earlier, and they would be able to draw Social Security benefits sooner. So I mentioned some of these that you have more time for your savings to grow. You're closer to the age where Social Security benefits are available. Now, Social Security benefits are available as early as age 62, but that is a permanently reduced benefit. Full benefits start around age 67 for probably most of us on today's webinar. You don't have to draw at your full retirement age. You can wait as late as age 70 and receive a higher Social Security benefit by receiving delayed credits. Some noteworthy facts that I just threw in here are that since the county stopped offering retiree health insurance, the average age of a new retiree increased from the mid to late 50s now up into the early 60s because they have less time to wait until Medicare is available. Now, Medicare is available at age 65. That's available whether or not you are drawing your Social Security benefit, and you cannot get Medicare early unless you are disabled. So even though you may start Social Security at 62, you still wouldn't be eligible for Medicare coverage until age 65. One item that people have a tendency to not realize and don't take into their planning is that your Social Security benefit may be taxable. At least a significant portion of it is based on the total income for adjusted income on your tax return. So you would need to consider how much of your Social Security benefit is going to end up being taxable and account for that. If you are working and you are below your full retirement age, your Social Security could end up being reduced if you earn over a certain amount. They have a Social Security earnings limit where if you're working, receiving benefits, and you earn more than that, they will reduce your Social Security benefit.
We've got 3 minutes, Doris, and we do have a question.
This is my last slide, essentially. So the important takeaway here are to try to control what you can and make the most of those things. Save early, save more. That your pension does not have a cost of living adjustment. That your retirement could be very long. Plan some more. Run lots of different scenarios. Consider both the retirement you want and retirement you don't want. There are a lot of books and calculators and resources out there. Talk to your IRA or deferred compensation providers, or Sarah, don't be afraid to ask questions. So with that, I'm going to wrap up with any final questions from the audience before we turn it over to our next presenter.
All right, we have a question from Jay. Is the final average salary annual or monthly?
We calculate the 3-year final average salary on 78 pay periods, and then it's converted into a monthly average salary. So the benefit computation is based on your monthly salary, and that determines your monthly benefit. So in closing, I'd like to thank you for joining us today. Hopefully, we've given you a lot of useful information that you can use in your retirement planning. If you have any questions, please contact our office. You can reach us by email at retirementassociation@mendocinocounty.org.